Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business. What it does, how it makes money, and what makes it competitively distinct.
Western Digital is the world's leading manufacturer of hard disk drives. Following the 2024 spin-off of its NAND flash business as SanDisk, Western Digital is now a pure-play HDD company focused on cloud and enterprise storage markets.
Founded in 1970 in Southern California, Western Digital has manufactured storage for over 5 decades. The 2012 acquisition of Hitachi's HDD business was transformational, combining 2 large HDD platforms into a single global leader.
Revenue breaks into 3 areas: cloud HDD at about 70%, client HDD for PCs at 20%, and consumer portable drives at 10%. Cloud is the growth driver as hyperscaler data center build-out accelerates.
Hard disk drives are not obsolete. For large-scale cold storage, archiving, video backups, HDD remains dramatically cheaper per terabyte than flash. That cost advantage sustains HDD in cloud data centers for years to come.
Western Digital and Seagate together control approximately 80% of worldwide HDD production, a functional duopoly that reduces competitive intensity compared to most technology hardware markets and enables more rational pricing behavior.
The UltraStar Enterprise HDD brand serves major cloud providers. UltraStar drives optimize capacity, reliability, and total cost of ownership for the exabyte-scale storage demands of hyperscaler data centers.
CEO David Goekler joined from Cisco in 2020. He managed the HDD and NAND businesses through a challenging storage cycle and led the SanDisk separation, remaining CEO of the pure-play HDD company post-spin.
Western Digital does not currently pay a dividend. Management has prioritized balance sheet repair and cloud storage investment post-spin, with focus on free cash flow generation and leverage reduction rather than near-term capital return.
Gross margins run 28 to 32% in a healthy cycle. The storage industry experienced a severe downturn in 2022 and 2023 as inventories built up. Recovery has been underway as data center demand resumed.
Helium-filled HDD technology is a key differentiator. Helium drives hold more platters than air-filled alternatives, delivering higher capacities per drive and reducing cost per terabyte, the critical metric for hyperscaler purchasing decisions.
AI infrastructure build-out is a positive catalyst. AI compute generates massive data sets, needing cost-effective long-term storage. HDD's cost per terabyte advantage makes it the natural candidate for archival workloads adjacent to AI compute clusters.
Seagate is Western Digital's primary rival. Toshiba Storage holds a smaller share. The 3-player structure provides meaningful market rationality compared to commodity hardware markets with many fragmented competitors.
Western Digital ships products to customers in over 100 countries. The company has shipped over 2 billion drives in its history, reflecting its central position in the storage infrastructure underlying most digital information systems.
Western Digital is a cyclical technology business with a durable duopoly franchise. Improving capacity technology and cloud storage demand expansion define the long-term case, with the near-term variable being the pace of hyperscaler investment.
That's the company chapter for Western Digital. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Western Digital just posted its first full quarter as a pure-play hard disk drive company, and it was a blowout. Q3 fiscal 2026 revenue hit $3.34 billion, up 45% year over year. EPS came in at $2.72 versus the Street's $2.36 estimate, a 15% beat. Stock jumped 4.3%. The CEO says they're sold out for all of calendar 2026. This is Charged Alpha. Let's break it down.
Western Digital is now a pure-play hard disk drive company. After spinning off its NAND flash business as SanDisk in February 2025, WDC focuses entirely on HDDs, primarily nearline drives sold to hyperscale cloud customers storing massive volumes of data. Market cap sits around $140 billion at $4.12 a share. The HDD market is a tight oligopoly. Only 3 meaningful global players remain: Western Digital, Seagate, and Toshiba.
The setup right now is unusual. AI training and inference workloads generate enormous data volumes that need cheap, dense, durable storage, exactly what HDDs deliver per terabyte. Cloud revenue this quarter was $3 billion, 89% of total revenue, up 48% year over year. The post-spin WDC is leaner, simpler, and pointed directly at the most secular tailwind in enterprise infrastructure today.
Let's walk the numbers. Total revenue was $3.34 billion, up 45% from roughly $2.3 billion in 2025. Gross margin crossed 50%, specifically 50.4%, a record level for the post-spin business. Operating margin came in at 33.6%. These are HDD economics that look more like specialty semiconductors than legacy storage.
On unit volumes, WDC shipped 222 exabytes of HDD capacity in the quarter, up 34% year over year. Of that, roughly 4.1 million enterprise drives. The ePMR and Ultra SMR products at capacity points up to 32 terabytes accounted for 118 exabytes. Average selling price per terabyte was up low single digits sequentially, with management guiding pricing to high single-digit increases by late calendar 2026.
Cost per exabyte was down 10% year over year. That's the leverage story. WDC is shipping more capacity, charging more per terabyte, and lowering its unit cost simultaneously. Aerial density gains and Ultra SMR adoption are doing the heavy lifting on cost, while constrained industry capacity is doing the heavy lifting on price.
Free cash flow was $978 million in the quarter alone, a free cash flow margin of 29%. Trailing 12-month free cash flow now stands above $3.28 billion. The balance sheet shifted dramatically. WDC sold 5.8 million SanDisk shares this quarter, generated $3.1 billion in proceeds, and used that to slash debt.
Cash on hand is roughly $2.4 billion. Total debt dropped to $1.55 billion. That puts WDC in a net cash position of around $450 million, a remarkable swing from the heavily levered company it was just 2 years ago. The company still owns 1.7 million SanDisk shares as a residual asset.
Capital return was reactivated. The quarterly dividend was raised 20% to 15 cents per share, payable in mid-June. WDC also repurchased $752 million in stock during the quarter, about 2.9 million shares. Total return to shareholders since the program launched a year ago is $2.2 billion. This is a different capital story than pre-spin Western Digital.
Analyst sentiment is broadly bullish. Of 26 analysts covering WDC, 20 rate it buy, 6 rate it hold, and 0 rate it sell. The average price target across that group is roughly $372, but the high end of the range tells a more aggressive story. Bank of America's Wamsi Mohan raised his target to $495 in late April, while Citi's Asiya Merchant moved to $405.
On valuation, WDC trades at roughly 38 times trailing earnings and 32 times forward estimates. Price to sales is 11.1. Those multiples sound elevated for a hardware company, but they reflect the post-spin reset. With the NAND business gone, what's left is a high-margin, capital-efficient HDD pure play with structurally tight industry supply.
The bull thesis on the street is straightforward. HDD demand for AI-era nearline storage exceeds industry supply. WDC's CEO told analysts the company is, quote, pretty much sold out for calendar 2026, end quote. When a commodity-adjacent business runs sold out for 12 months forward with rising prices, the multiple expansion follows.
Q4 guidance reinforced the setup. Management projected revenue of $3.65 billion at the midpoint, plus or minus $100 million. That's 40% year-over-year growth. Non-GAAP EPS guidance is $3.25 plus or minus 15 cents. Both numbers came in well ahead of consensus and triggered upward revisions across the analyst community.
The hold ratings are not bearish. They're disciplined. WDC stock is up roughly 135% year-to-date in 2026, on top of the massive rally in 2025. At $4.12 a share, even bullish analysts see limited near-term upside to the average target. The debate is about pacing, not direction.
Bull case rests on 3 pillars. First, structural supply discipline. The HDD industry consolidated to 3 players over a decade. None of them are racing to add capacity. AI demand is colliding with that constraint, and pricing is responding. This is rare in commodity-adjacent hardware.
Second, the pure play margin story. Without NAND dragging on results, WDC's gross margin crossed 50%. That margin level was unimaginable for HDD a few years ago. As mix shifts further toward enterprise nearline at higher capacity points, incremental margins expand even more.
Third, the capital allocation reset. Net cash position, 20% dividend raise, active buybacks, and $3 billion in debt paydown from SanDisk share sales. This is a company returning to shareholders aggressively while supply visibility extends through calendar 2026. That's a durable compound.
Bear case starts with the cycle. HDD has historically been a brutally cyclical business. The 2022 and 2023 downturn cratered earnings and forced WDC to slash production. Memory of that pain is fresh. The current upcycle will eventually peak, and exit multiples on cyclical hardware compress fast.
Second, long-term solid-state substitution. NAND flash prices keep falling. QLC and PLC NAND increasingly threaten HDD on a total cost of ownership basis for some nearline workloads. WDC's bet is that HDD remains the cost leader on dollars per terabyte for archival storage for many years, but that gap narrows every cycle.
Third, customer concentration. Cloud revenue is 89% of the total. A handful of hyperscalers, Microsoft, Amazon, Google, Meta, drive demand. If any one of them shifts allocation towards Seagate or accelerates SSD adoption, WDC loses outsized revenue quickly.
Fourth, post-spin transition noise. WDC still owns residual SanDisk shares, and ongoing monetization adds non-operating items to results. Analysts have to model out what's recurring versus what's one-time. That complicates valuation work and can lead to pockets of confusion in earnings reactions.
WDC's most direct peer is Seagate Technology, ticker STX. Seagate also operates pure-play HDD and is benefiting from the same nearline cycle. The two companies essentially split the enterprise HDD market, with Toshiba taking a smaller share. Seagate trades at similar revenue multiples and has reported parallel margin expansion.
SanDisk, ticker SNDK, is the sibling. Spun off from WDC in February 2025, SanDisk holds the legacy NAND business. The two stocks now move on different cycles. NAND has its own oversupply risks while HDD pricing is firming. Investors who want pure HDD exposure choose WDC. Those who want NAND exposure choose SanDisk.
Micron Technology, MU, is a broader memory peer. Micron does DRAM and NAND, both currently in different parts of their cycles. Micron's revenue base is larger and more diversified, but it lacks WDC's tight oligopoly dynamic. The HDD industry has 3 players. The DRAM industry has 3. The NAND industry has 6. Structure matters.
What separates WDC from this peer group is the combination of pure play focus, oligopoly supply discipline, and the AI nearline demand signal. STX shares the structure but not the SanDisk share monetization tailwind. SNDK is the inverse exposure. MU is more diversified but more competitive. WDC sits in the cleanest setup of the 4 right now.
Options activity around earnings was elevated. Implied volatility before the Q3 print priced roughly a 6% move. The actual 4.3% jump landed inside that range, so straddle sellers captured premium as IV crushed. Open interest skewed bullish. Call buying outpaced put activity by roughly 3-2 heading into the report.
Looking at longer-dated options, the January 2027 series shows substantial call open interest at the 450 and 500 strikes. That positioning aligns with Bank of America's 495 price target and reflects institutional conviction that the AI HDD cycle has multiple quarters of runway ahead.
Put protection at the 350 and 375 strikes is meaningful. Long-only managers hedging gains rather than betting against the stock. Given the year-to-date run of roughly 135%, hedging behavior is rational and doesn't signal directional bearishness.
On insiders, routine 10b5-1 selling by executives followed the SanDisk spinoff and the Q3 print. Nothing unusual, just scheduled diversification after a massive equity appreciation. Institutional ownership remains strong, with Vanguard, BlackRock, and a growing list of dedicated tech hardware funds among the top holders. Insider conviction is reflected more in capital allocation choices, the dividend raise and buybacks, than in open market purchases.
Bottom line on Western Digital: a clean post-spin pure-play HDD story riding an AI-driven nearline storage upcycle. Margins are at record highs, capacity is sold out for calendar 2026, and the balance sheet flipped to net cash. Risks are cyclical, not structural, for now.
The setup favors continued strength through fiscal 2026, but the stock has already moved hard. Charged Alpha rates this a quality long with cycle-aware sizing, strong business, real tailwind, elevated entry. Take profits into strength, hold the core.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.